We're talking top of page 10. How are you going to put this in your paper? I'm just asking the question after all he said, those six things we talked about, does this seem to contradict it, or is there something in here that falls back to what he was saying? So he's moving fast. They're retaining it all on their own account. They're not getting any help from anybody, not splitting up the risk. They're insuring refineries. They're insuring against active terrorism. What he said about terrorism, it's probability is not zero and probably rising. So he said there's a lot of uncertainty. How does that coincide with you better have data to assess the risk if he's insuring terrorism risk when he just said it's a tough one? Another oil seed platform, Sears Towers, which is not the Sears Tower anymore. Mini jumbo risk as well. World Soccer Tournament, the 2002 Winter Olympics. He does give a caveat. We've attempted to avoid writing gruesome policies which might seriously aggregate. So here's my issue with that. Is there a way unrelated thing could suddenly be correlated? So you got some person out there that wants to cause major destruction. He said, I need some ideas where I could attack. Here's a good list. If you're looking for 6 or 7 places to attack, here's Warren Buffett say, hey, here's some ideas. So the simple fact he threw all these on one page kind of suggests, these could become correlated. Sporting events are particularly popular because they get a lot of TV coverage. That's essentially if you're trying to create terror in the world, you want a lot of people seeing it at the same time. The oil rigs, that might not be as popular, but he's getting them some ideas. They may be easier to attack because they're out there all by themselves, whatever. So that unintended correlation, has he increased that probability of unintended correlation by simply listing all these all in the same paragraph? So he says we attempted to avoid writing groups that could aggregate, except for the fact that we just put them all in this paragraph. So what did he do? Well, I think one of the biggest problems with risk management, what did he do? He says, well, we're going to be careful that the thing that hit us in 2001, that we're not exposed to that. So yeah, the last thing that just messed up for us, we're not going to do that again. Well, is their next big event likely to be like the last one or be something completely new? He's kind of saying, hey, let's not insure a bunch of employers in one building. Okay, but that may not be the next one. I went to the Olympics in 2004, not as a athlete, but as audience member. It was in Athens. I was thinking, man, this is a danger. We were actually worried about it. If someone was to attack, my word, it would be the subway. The subways were just packed with people. Very little security on the subways. They could have done some tremendous damage. Athens was not really ready for the Olympics. They had to throw it together, a lot of it last second. You could tell they weren't ready because if you drove around the country, there was a bunch of construction projects that just stopped midstream because everything went to the Olympics. So a lot of last second stuff. It looked like they wouldn't get it all done, but there were no attacks. But while we were there, we were thinking about it. The Summer Olympics are probably easier to do than the Winter Olympics just because you get bigger concentrated crowds. But we really haven't had one since in the US since 9/11. So he probably did make quite a bit of money on these. What about now, today, 20 years later? Are they still going by these? So that, I said you need to add something else, 10%. You might go into their annual report for 2025 and see what are they bragging about this year? Does it sound like they've earned? You could really enhance this discussion. I'm sticking with the 2001 just because it was such a unique event. But what are they bragging about today now that they have a new CEO? I believe Ajit is still there. He was actually a possible replacement for Warren Buffett. The next sentence to me is a bizarre, maybe the most bizarre sentence of this whole thing. No one can match the speed with which Ajit can offer huge policies. Does that sound consistent with the list of 5 things? His quickness has become a major competitive advantage. So So it's an interesting piece. The piece we didn't really talk about here was loss reserves. We'll get into that later in the class. Read that part of it. It's in those pages. Essentially what he's saying is the insurance industry has a bad reputation for setting up adequate reserves. They tend to lowball them. I don't believe that's true, and you'll see that later when we look at the accounting. I think the insurance industry actually does a pretty good job in most cases of setting up adequate and even a little bit over needed reserves. There are some exceptions. We'll talk about asbestos and how the insurance industry materially under reserved for asbestos. But I disagree with some of his discussion there. But anyway, if you're interviewing within a property casualty insurance company, that list of 6 items plus the discussion on experience and exposure will put you in really good shape for the interview. So it's keep those in mind. Don't forget everything you learn in your classes. All right, any questions on the paper? You got plenty of time to finish it, but write it right now while it's fresh in your mind. You're thinking about it. Bring your draft to me. You can even bring it in stages if you want. So if you haven't had me for a class before, those that have had me know I'm really picky on grading. I don't like fluff. Fill it in, full discussion. Make sure I understand that you understand the full topic. All right, let's continue on this economics and kind of the background on this industry. We talked about frequency and severity. Frequency can be one or two things. In the life insurance side, frequency is usually the probability something happens. So in life insurance, we had a mortality table. It showed the probability someone would die at every age. Male or female, smoker or non-smoker, avocation, all those kind of things. So it was a probability. On the P&C side, it tends to be number of claims versus probability. So how many claims do you expect from this age group driving cars? And then severity is the average claim. So the expected loss is simply going to be frequency times severity. And property and casualty expected loss is referred to as the pure premium. We'll see that later when we talk about credit scores. The life insurance side calls it the net premium. The property and casualty calls it the pure premium. Pure premium means just the premium just to cover claims. Doesn't have any expenses or profit, that kind of thing in it, only to cover claims. So you got a male driver driving a really, really powerful sports car that's red. That actually makes a difference. What is that frequency going to be? Really high. What's the severity going to be? If the car is expensive, pretty high. Those in my life insurance class, you remember the strange thing the mortality did in the 20s? What do you think mortality does as we age? It increases, right? We're more likely to die, except for what? One exception. Men ages 20 to 26. What does it do? It falls. Why? Because of driving. Men are horrible drivers. And because of that, their mortality is higher at age 20 than it is at age 26. And you'll learn that if any of y'all have 17, 8-year-old kids and buying auto insurance, I don't know if any of y'all have, we're too young, but if you have a male and female teenage driver, you're probably going to notice a difference in premium between the male driver and the female driver. So if the probability of an accident is 2% and the car is worth $50,000, then you need to charge them at least $1,000 for that policy. 2% times the 50,000. You're going to charge more than that. Remember, the pure premium is usually about 70%. Remember that loss ratio we looked at is about 70% of the premium. So you have to charge that extra like 30, 40, 50% on top of that to cover expenses and profit. Insurance, just always remember, insurance is a losing proposition on average. You will, over your life, if you never bought insurance, you'd probably be ahead by the end of your life because you're paying more than the pure premium. Your expected loss is the pure premium, but you're paying the actual premium, which is going to be 30, 40% higher. So of your lifetime, you would probably on average be better off. So why in the world do we buy insurance? Because if the 50,000 happens, that's so devastating to us. We'd rather pay more than expected loss and actually ever face that expected loss. Now, what do you do if, and we'll talk about this later, what do you do if you know you're a better driver than average? Can you convince the insurance company? It's like, yeah, I'm a 22-year-old male. I got a race car. It's red, but I'm a really good driver. Are they going to believe that? How are they going to rate your policy? They're going to put you in with all the other 22-year-olds. And there's not much you can do about it. That we can call that a false positive. You're classified as a risky driver and you're really not. Anybody guess how we could fix that for this poor 22-year-old?
Maybe some systems in place with some auto insurance companies where they like monitor your speed.
Yeah, telematics, exactly. I have telematics on my phone and it doesn't work because I switched phones and USAA keeps telling me you need to push this button. I push the button, nothing happens. So they're saying you're going to lose your telematics because the new phone for some reason can't fix it. But yeah, telematics could do it, and telematics is becoming much more popular. So we may come to a point where each person is going to get their own insurance rated policy. They'll get their own assessment of first frequency and severity. Severity has a couple points. One, how expensive is your car? If you're driving a $7,000 car versus a $60,000 car, obviously severity is being higher for the more expensive car. You also have the liability side, which is the damage you cause to others. So that's going to be factored in as well. So if you're a really good driver, but you're in a category with really bad drivers, generally you're going to pay more. And if you really and truly are right that you're a better driver, telematics might be your solution. That's why I brought up the company Root that really focuses in on telematics. They monitor your driving. Are you using your phone while you're driving? Are you making jackrabbit starts? Are you speeding in places? So that might solve that problem. Telematics is also heavily using AI to try to relate all these numbers together and try to figure out. I mean, there's some interesting data that actuaries have found. AI might find it. If you live across the street from a church, you're a better driver than if you live across the street from a bar, even if you don't go to church and even if you don't drink. Just the fact that you live in those places. If you live 2 inches outside of Bexar County, you're a better driver than if you live 2 inches inside of Bexar County, or you're less likely to have your car stolen. There are some hard and fast rules that you think that doesn't make any sense. Why would 2 inches make a difference? But that's the data they have. So telematics might be your protection. The problem is the overwhelming majority of drivers think they're above average drivers. It's not true, but we tend to exaggerate how good of a driver we are. All right. So on average, you're going to lose money. You'd be better off. The insurance industry is an expensive industry. Their expenses are high. They have some high cost experts, actuaries, underwriters, investment professionals, other experts that just make them expensive. This is a very heavily regulated industry. They have a lot of regulatory people, a lot of lawyers, loss adjusters, that kind of thing. That's why that expense ratio is so high, 25, 30%. The money you're paying in is just going straight to pay for expenses. So when should you buy insurance? If it's such a horrible transaction for you, when should you buy insurance? And the key is frequency and severity. You want to buy insurance when your frequency is low and the severity is high. I don't know if I do that. Yeah, we'll come back to that and discuss it. But a key concept that you should do, go out to your, I don't know if y'all even look at your auto insurance policies. Are you buying the same insurance your parents bought without thinking about it? So this might be a good time to go check it. So in Canvas, I have an example of this that I really like to do. I highly encourage you. It's up near the top. Rate line example. Another good term to know if you're going to be in an interview, because they being pressed, you know what this means. So Part D of auto insurance is your comprehensive and collision. That's your car, damage to your car, right? But to your car, not the stuff in your car. So if you have golf clubs in your car, does auto insurance cover that? Doesn't what covers your golf clubs? Your homeowners insurance, all right? So we're talking about the car itself, all right? If you leave your computer in the car, you leave whatever in the car. So this is Part D. Part D has a deductible, right? Part A is liability. Parts B and C is essentially medical insurance, which I don't care for, and auto insurance. But Part D is your comp and collision. So it's the part that covers your car for damages to your car, and you have a deductible. I got these numbers for me from USAA.com. You can go in USA.com, probably Allstate, State Farm. You can go in and say, how would my premium change if I changed my deductible? So here's $100 deductible, $500 deductible, $1,000 deductible. Here's the premiums. Obviously, the premium is going to be the highest for $100 deductible. And it drops almost in half for $1,000 deductible. So what Rate Online says is, what is the additional coverage I get for moving from 1,000 to 500? I get $500 more coverage. Everybody see that? And your premium goes up 46 bucks. So your rate online is 9.31%. You're paying you're paying 9% for the additional coverage. If you go from 500 to 100, your additional coverage is only $400, but your premium shoots up $140. That $400 coverage, you're paying for 35% of it in your premium. So which of these would you definitely not do? Yeah, $100. You're paying way too much for that. All right. So I don't know how many of y'all have a $100 deductible, but if you want to cut $10 a month off your insurance premiums, just move from 100 to 500. Now the choice between 1,000 and 500, an extra 46 bucks, and you get $500 in coverage. That sounds like a pretty good deal, especially if you're a college student working part-time. 500 bucks is a lot of money. So if you have a serious accident, you say, you know, I can't really afford that 500 bucks. Then yeah, $500 deductible. I have $1,000 deductible, and then when my car hits 10 years, I go to no Part D. I'm like, crash my car, I'll call an Uber, I'll drive to the dealership and buy a new car, and I go home. That's kind of where I am. But I'm in a different stage in my career than y'all are. Plus, I'll buy cheap cars and drive them forever and ever and ever. I'm a cheapskate. So at some point, I just get rid of the deductible entirely. It saves me 290 bucks. But try this. Go to your website for your company and make sure you're not wasting money. Now, someone's going to change from $100 to $500, and 2 days later have a $700 accident. You're going to be all mad at me. So you're on your own. I'm not making any recommendations. But for me, I look at the rate online. When we talk reinsurance later, rate online is extremely important. When your deductible is $1 billion versus $3 billion, you're really looking at how much extra premium are you paying to get that coverage, because it gets really expensive. So try this. You can do with all parts of your coverage. In Part A, your limits might be 100,000 or 300,000. Your deductibles can be all different levels. Think about how much additional coverage am I getting versus how much additional premium, and then make sure you're spending your dollars wisely. This is particularly true when we talk about Parts B and C of auto insurance, which I think is very redundant. Most of y'all already have coverage for B and C without it in your auto insurance. So to me, it's almost 100% wasted money. But you have to say, I rarely convince the class of that, but we'll see if I can convince you this time when we get to auto insurance. But remember, rate online. Rate online is the additional premium divided by the additional coverage. 46 bucks divided by 500, or 139 bucks divided by, and if you wanted to do the 1,000 versus the 100, you could do the same thing. It looks cheaper, but Part of it is most of the coverage is between 100 and 500, which I think 500 really is the sweet spot for most people on auto insurance, unless you just don't want to pay. I mean, if you can handle the 1,000, you just know you're paying more in insurance than you're probably going to get back. So, you know, you might as well save the money. All right. So rate on line's a good number to know, not just for your own personal needs, but in an interview, it'd be good to understand that concept. All right. So we got two questions. One of them is really, really tough, and one of them is really simple. The really tough one is on the exam. The really simple one's not, unfortunately. So make a note. We're going to get this is the question that's on the exam. This isn't actually the correct question. The question is, should corporations buy insurance? We're going to start with the easy question is, when should individuals purchase insurance? And then we'll get to this question, should corporations buy insurance? And that's all going to come back to, believe it or not, the capital asset pricing model, which hopefully you remember. If not, I'll remind you of it. But we'll get back to it. So actually, there's three questions. Should corporations buy insurance? When should individuals buy insurance? And when should or can insurance companies sell insurance? And that's going to overlap quite a bit with what Warren Buffett said. So you'll see where we're going. Three questions here. One of them will be on the first exam. A pretty tough question too, but it's a good question. It brings finance and insurance together. All right, so the first one I've already alluded to, when should individuals purchase insurance? So what about things that don't happen very often? When they happen, they're not very severe. The answer there is don't buy insurance. Why? Because you know every time you buy insurance, you're overpaying for the risk. Why buy something that you can handle yourself? Good examples of that is warranties and towing and labor. I don't know if I've told you the story yet, but I might have. But did I tell you about buying the TV at Conn's? I think it was a $16 TV. And I get up front and they offer me a warranty for $9. And I told the guy, if I drop it in the driveway, I'll just come back and buy another one. It's like, why would I insure it? And he laughs and, yeah, right. But do you want to buy the insurance? Like, no, that's what I was saying. I don't want to buy the insurance. Why do I pay $9? What's the rate online on that? Pretty ridiculous, right? So warranties, that includes Apple phones, which would be interesting. We kind of talk about that. You might look at Apple phones from a rate online perspective. I think towing and labor falls in there. Remember, towing and labor on an auto policy, it only comes into play for a covered loss. So if you have maintenance issues, flat tire, those kind of things, towing and labor won't cover you. But if you have an accident and your car can't be driven, then towing and labor comes in. A lot of people buy it just because they don't think about it. It looks pretty inexpensive. It might be $10 a year. But $10 a year on something that might cost you $100 every 20 years is pretty expensive. And you can probably handle the $100 every 10 years on your own. But towing and labor, you might look and see how much you're paying for that. But a lot of people just say, man, it's less than $1 a month. Why not? Maybe. So what you do here, just risk retention, just retain the risk yourself, and then just be careful, loss control, watch out what you're doing. What about things that happen all the time, but they're not all that expensive? Again, here, and especially here, you don't want insurance because it happens all the time. It's going to be extremely expensive for the insurance company to manage it. They're going to hire a lot of claims adjusters that take all these calls. So insurance is not good. We do this, dental insurance. You go to the dentist twice a year. If you don't have insurance, they would charge you $70 twice a year. If you have insurance, the insurance covers it and the insurance company is charging you $100. Do you want to pay $70 twice a year or $200 to your health insurance company? Which would make more sense? I'd rather just pay the $70. And when I go to the dentist, it's kind of nice when I finish, I hand them a credit card. They don't have to. What if I hand them my health insurance card? What do? They got to send the claim to the health insurance company. Insurance company's got to process it, send it back, send the payment. It's a mess. So now I realize there are dental situations like root canals can get expensive. Dental insurance doesn't cover those very well. Their limits are really low. It's kind of the worst insurance out there. I wouldn't mind dental insurance if it just covered the big stuff, but because it covers cleanings, it's just an incredible waste of money. And doctors and dentists don't care much for it because it creates a lot of extra costs for them. Health checkups. We talked about this in my life insurance class. You're better off just paying those out of your pocket and having insurance pay for it, because it's just there's no way the insurance industry is going to make that process better by paying for it with all the middlemen, middle women you have in the process. So the best thing here is just pay it out of pocket. John Stossel, he actually has a video on this where he talks about this type of insurance being like buying insurance for your groceries. You buy an insurance policy from HEB and they say, hey, if you end up having to buy groceries in a week, we'll cover you up to $300. The policy costs you $380. Would you buy that policy? You can get up to $300 of groceries. You only have to pay $300. Why did they charge you $380? Because you're going to use it every single week. So essentially, you're just paying them to pay the bill, and you're paying them extra $80 to do it. Doesn't make a lot of sense. What about stuff that happens all the time? And when it happens, it's terrible. Well, insurance would be great if you can get it. Boy, is it going to be expensive. A very, very sick person buying life or health insurance with the Affordable Care Act, yeah, there's these open enrollments. So if you're really, really sick, then yeah, you can come out ahead on that. You know you're going to have a $100,000 surgery. You get the open enrollment, you get to buy it. Affordable Care Act promises you a certain deal. That's good. As we talked about in my life insurance class, what was the number that you can't charge anyone more than 6 times more than anyone else, which means what? What are young people doing? Y'all remember that? Young people are subsidizing old people in health insurance. You guys are being forced to pay a whole lot more. So there are people out there in this category. It does make sense for them to buy insurance because it's by design very subsidized, and that's what health insurance is with the Affordable Care Act and with other, even your employer. Building a house in a floodplain, 16-year-old drivers can be really tough. Life insurance for people in war. USA is one of the only life insurance companies that actually insures people when they're active service, but it does limit it to a pretty low level. Our government now finally has decent life insurance for people who die in active duty. They used to not do that, so it kind of replaced USA's need to do it, but it is more expensive because it's more likely to happen. So what do you do here? You just really can't afford it in this case unless it's just mispriced. The best thing is risk avoidance. If you got an expensive house on the coast, East Coast of the United States, it's just, I don't know, it doesn't make much sense. You probably can't insure it anyway because most of the flood is going to come from the federal government and the limits are going to be too low. So, don't buy the house, just, go stay in a 5-star hotel every once in a while. It's just much better. Or you just hope for the best, retain it. So insurance is really for things that don't happen frequently. And when they do, they're very severe. We've referred to this as catastrophe insurance. This insurance works well. The low frequency keeps the expenses low for the insurance company, which is what you need to keep the costs down as much as possible. And the high severity means that if it happens, you're really glad you have the insurance, but it's unlikely to happen. And so the insurance is fairly inexpensive. You're still paying more for it than you should because of the expenses and profit, but not so much that it's really wiping you out. And you somewhat saw that in the right online with the $1,000 deductible. With the $1,000 deductible, a lot of insurance claims get kicked out from the insurance company. They don't have to handle them. That reduces their cost dramatically. So those small vendors just never come to the insurance companies, keeps their costs pretty low. All right, so yeah, we just did this rate online, so keep that in mind. It's in a really, really good way. Which means you need to stop and think, where are you buying insurance? I can't tell you what low frequency means, but it should be pretty rare. And high severity is different for each person. For some people, 500 is high severity. Other people, 50,000, 100,000 is high severity. It just depends on your financial situation. If you can get away with higher deductibles, you can handle it. It really won't wipe you out to cover those. On average, you're gonna be a lot better off just not buying the insurance. All right, any questions up to there? So that's the second question, I guess, first question here. Individual buy insurance for low frequency, high severity events. And you should still look at the pricing. And you should also compare rates. I haven't done it in a while, but I do every once in a while. I have USAA insurance. It's very convenient for me to have it both for my condo and my car, but I do go out and price it every once in a while just to see what the pricing might be. My auto insurance is really low because I do have a high deductible on D and I don't use B and C. I worry about liability risk, but I have an umbrella policy because it's a big risk for me. So I've thought about it a lot. Where do I want to spend my money? Part A insurance to me is so cheap, and that's where I'm most worried. I'm more worried about accidentally running into a bus with a bunch of school kids on it and causing a bunch of injuries. That's going to wipe me out. Than I am my 8-year-old car getting damaged, and I'll just buy a new one. So I think about it in my definition of frequency and severity is probably very different than a typical college student. All right. Are y'all ready for the exam question? It's a tough one. Anybody know who William Sharp is? Any big prizes he's won that Trump hasn't won? Well, not exactly, but so Nobel Prize, not Nobel Peace Prize, but Nobel Prize winner in economics. What famous thing did he invent? Well, the Sharpe ratio, but related to Sharpe ratio, capital asset pricing model. If you're a finance major or an actuarial major or accounting major or marketing major or whatever, every business major knows what the capital asset pricing model is. If you took a finance class, you had it. Do y'all remember it? Maybe the most famous formula in the entire history of finance. He wrote it in the early 60s. He wrote it after Markowitz wrote his famous paper. Here's his own line from Stanford. I don't think he's at Stanford anymore. He's getting up there. He doesn't look like that anymore, but he's getting up there. 34, so he's in his 90s now. Still going, he's still doing stuff. He was really famous for bringing the computer into finance in the 70s and getting us more sophisticated, but he's an economist, not a finance person, but very famous. If you look at his webpage, the capital asset pricing model is maybe not exactly in there. His original paper, it would be interesting to see his original paper. It's probably the most referenced article ever written by a PhD student before. It's interesting when William Sharpe and Harry Markowitz was in the late 50s, Sharpe in the early 60s. At that time, you didn't do finance. Finance was considered to be kind of this kind of lower quality, unimportant field. And so Markowitz and Sharpe kind of started off having economists start doing papers and analysis on finance itself, not just on economics, and had a huge impact. Some of these are really great articles. The Parable of the Money Managers, Arithmetic of Active Management, great articles. There's a Sharpe ratio. You can see these are pretty old articles, but very famous, very famous articles. What in the world does that have to do with insurance? So the question, be real clear on the question, should corporations buy insurance? We said individuals should buy insurance for low frequency, high severity events. That can make some sense. So what about corporations? So the capital asset pricing model is a little bit bizarre. Capital asset implies it's a model for all assets, but we really only use it for stocks. We don't use it for bonds and real estate. It's really not a pricing model. Really, all it does is gives you a discount rate. And it's really not even a model. It's actually just a formula. Does anybody remember the formula? Because you want to put this on your answer.
Plus data on the market, for the market group.
Yeah, perfect. So you can do it two ways. You can do, well, KE is the cost of equity capital because this is mainly for stocks. The risk-free rate, what do we usually use for the risk-free rate? 10-year treasury. All right, good. All right, so you're getting similar to what I teach it. So I don't know what professors you have, but yeah, very similar. So the equity risk premium, some people write it out as the return on the market minus the risk-free. But in reality, we just say the equity risk premium or the market risk premium. So the risk-free rate today is about 4.3%. The beta for the stock market is 1.0. So essentially beta is how you adjust risk for individual stocks, with the average stock being at 1. So if you're more cyclical stock that's really sensitive to the economy, what might you use? If you're doing like Ford Motor Company with a lot of debt, what beta might you use there? 2 or 0.5? 2. A very cyclical company, use a high discount rate, high beta. You're doing Walmart or the utility or Kroger's, you might use something like 0.4, 0.5. Those that are not cyclical, very defensive stocks. And then the market risk premium is somewhere around 4%. And so essentially what William Sharp came up with is he said, Markowitz, he did a great job. But what Markowitz did is he took all the stocks in the United States and he correlated them to each other. And I don't know how Markowitz did it in the 50s because they didn't have computers back then. I don't know if he's using slide rules. They didn't even have calculators back then. How are you going to figure out the correlation of 500 stocks each to each stock? I mean, can you imagine the math that would take? Maybe he went back 6 months or a year. He must have had a bunch of PhD students working for him. And William Sharp comes in and says, you know what? We don't need to correlate each stock to each other. You have 500 stocks. You got to take each one and correlate the other 499. That's going to just be thousands of calculations. William Sharp said, no, just take each stock and correlate it to the stock market. And even then, you don't have to look at their total risk. You just look at the risk the stock has that's relative to the market. That's really, really key to what he's talking about. So William Sharp took what Markowitz came up with in the 50s, and he came up with this one factor model. Just look at each stock and correlate them to the overall stock market and look at how they move versus the overall market. Do they have more systematic risk or less systematic risk? So famous formula in finance. So what is beta all about? Because that's real key to our answer. Beta is a measure of relative, that's a really key term, non-diversifiable risk, also known as systematic or systemic risk. Relative to the market, we usually use the S&P 500 as the market. That's not quite accurate. It really should be every stock in the world, but we just tend to do everything to the S&P 500. Usually when you see a beta, it is to the S&P 500. And you probably had classes where you get the beta of the stock to the S&P 500, but then you might add a little bit more risk premium if it's a small company or if it's a non-US company. You kind of just add to it for smaller companies. So it's relative non-diversifiable risk. Maybe I can show you. This is such a critical thing. If it's been a while since you've done this in finance, let's see if I can show you an example. I haven't taught an investment class in a while, but let's see if I can find one. All right, so here's a stock. I've got the stock's price, I've got the S&P 500, and I have their monthly returns. All right. And this is their beta over time. It's EXC. So you probably think a low beta for this firm. The Yahoo Finance says it's 0.57. What's that 0.57? Y'all notice what it says right here? 5 years monthly. So it's beta using monthly data for the last 5 years, 60 data points. All right. I do the same thing, but I do a rolling 5 years. So what's in Yahoo Finance is the very, very last point. This is a couple years old. The very, very last point. You can see here their last beta as of April 2025 was 46.9. You can see it goes all over the place, up and down. The median is 0.45. It's been as low 10% of the time, 0.01. It's been as high as 0.61. But definitely this is a stock below 1. This is a utility. Do you tend to cancel utility bills if you're worried about losing your job, the economy's not doing well? You're probably going to keep that going. Maybe even you might find ways to cut back on groceries before you might be more efficient with your energy, but you're probably going to keep paying for that. So utilities are low beta, non-cyclical stocks. And so what we're asking is how sensitive is this stock to the overall economy? We're not asking what its risk is. Its risk is its standard deviation. Its standard deviation is 21% versus the standard deviation of the stock market is 15. So it's actually more volatile than the stock market. So why are we using a beta below 1 if it's more risk? Shouldn't it be higher? And so what beta is asking is not how do these two things correlate, but it's really looking at how this thing correlates relative to the market's risk. So the systematic risk. So correlation of these two things is 0.25 or 0.26. There's a 0.26 correlation. So what is this telling you? What if we square this? What do we get? You get the R squared. Y'all remember the R squared? Anybody? What's that? 6.7%? You can explain 6.7% of the volatility or risk of EXC by looking at the volatility S&P 500. Some of y'all might have taken my investment class. This is the percentage EXC's risk that is systematic. How much of its risk is non-systematic? The rest of it. Oops, I don't know what I just did. Didn't even know that existed. So really key for CAPM. I love in interviews to ask CAPM questions. I love just saying, explain CAPM to me. And I'm expecting about a 2-hour answer. Finance majors, if someone says explain CAPM, you should be able to sit and type 20, 30 pages in Word without any notes. It's so important. And if you have forgotten CAPM or don't know it, go read it in Wikipedia or somewhere. You should just know it backwards and forwards. But what CAPM is saying is we're going to use beta to measure the systematic risk of the stock. That part of the risk of the stock we can't diversify. It's only 6.7% of the stock's risk. This is 93% of this risk of the stock is diversifiable. That means it disappears when you stick EXE into a well-diversified portfolio. That's pretty incredible, isn't it? 93% of the risk of the stock disappears by simply putting it into a well-diversified stock portfolio. So William Sharp says this is all you care about, the risk of the stock. Is that part? Why? Because if something happens to EXE, that's bad news. There's a good chance another company is going to have good news and they'll offset each other. 93% of its risk disappears by simply sticking it into a well-diversified portfolio. That's really key to this answer. So William Sharp is famous in the capital asset pricing model of separating systematic risk and unsystematic risk. You need to have the formula, you need to define these two. You're going to see here quickly, you're probably still like, what does this have to do with insurance? You'll see here quickly why this is so critical. But William Sharp says systematic risk is all we care about for an individual stock, because the unsystematic risk completely disappears when you put the stock into a well-diversified portfolio. So for EXC, 93% of risk disappears. We only care about that 6% that's left. And that 6% that's left is very low risk, very defensive, non-cyclical company. So we only care about the 6%, and that 6% is actually going to reduce the risk of your stock portfolio because it's a non-cyclical company. All right, that's a pretty bold statement for him to say. Do we believe it? Well, just go into Google. It works better in Google for some reason. You can say, in finance, is beta dead? Beta is not, even AI understands the question. Is beta dead? Market beta is not dead. Reports of beta death have been greatly exaggerated. Mark Twain there. Beta wanted dead or alive. Is beta dead? Beta is back. Is beta dead again? So I don't know what order they wrote that in. So you have to say in finance. I used to be able to type is beta dead, and all this stuff came up, and then something new came up related to beta. It has nothing to do with finance, and it dominated. But if you talk in finance, can we use beta or not? I am a believer in beta, but in a very specific way. If you see how I use it, those that took my investment class will remember I'm very picky on beta not being a number you get from Yahoo Finance, but it's actually a number you forecast. It's actually a future number that you're looking at for the company. So total risk is measured by standard deviation, and we saw that with EXE. Their standard deviation is 21.6% more risky than the market. Why? Because the stock market has 500 stocks in it. It's well diversified. All of that unsystematic risk is just disappearing. And because of that, the stock market's less risky than probably almost all the stocks in the market because of all that diversification. So EXE, which is considered a very low risk company, is actually quite significantly higher volatility, higher risk in the overall market. That's total risk. Total risk consists of systemic risk, that part of the stock's risk that's sensitive to the economy, sensitive to interest rate and inflation, and unsystematic risk. Unsystematic risk is that's specific to that company and their strategies and their industry. Systematic risk cannot be reduced by simple diversification. The only way to reduce systematic risk is you got to buy lower beta stocks. You want to reduce your systematic risk, you would sell high beta stocks and buy low beta stocks. So if you think we're going to have a recession this year, you would sell Ford, you would sell travel companies, you would sell consumer discretionary companies, and you buy grocery stores, utilities. That's how you reduce your risk, reduce your beta. The economy is the most systematic risk of all. So you're really asking, versus the average stock, how will this company perform if we have a recession? Walmart would do pretty well. Walmart had a positive return in 2008. I think it was the only stock in S&P 500 that in the financial crisis had a positive return. Walmart has done well in other recessions as well. Walmart has proven itself to be a good, it doesn't make like 20, 30% in a recession, but when everything else is crashing 20, 30%, it may be making 1%. So it protects your portfolio. So that's the big question. Beta is not a number you look up in Yahoo Finance. You can, but that only gives you a statistical number for the last 5 years. And you can see why I don't use Yahoo beta, because look how volatile it is. If you got on Yahoo Finance right here and used that beta, negative 0.25, and price EXC using that, you would be putting your whole portfolio at EXC. The stock would look so cheap. If you use this beta, you just happen to get in Yahoo Finance on that day and use that to price the stock, you would have such a high discount rate, you get a really low valuation for your stock and you would never buy it. The theory of beta doesn't quite know how to explain how volatile this is. Why is it so volatile? That's why I say it's more of a forecast. What do you expect for this company? What kind of company is it? It's a utility. Utilities tend to have betas in the 0.4 to 0.5 range, so that kind of makes sense to me. Now, unsystematic risk is more important to our question for this problem. Unsystematic risk, it's firm-specific risk. It can be industry-specific as well. It's diversifiable. I prefer the word idiosyncratic. It just sounds fancier, but it's that stuff that's specific to that particular company. And this is a really key phrase for this question. You can not just reduce, but you can eliminate unsystematic risk by simply diversifying your stock portfolio. Usually around 20 stocks that are from different industries, and your unsystematic risk goes to zero. In fact, in one phone call, you can get rid of all your unsystematic risk. Just stick all your money in a Vanguard index fund. You've got 2,000-3,000 stocks. There's no unsystematic risk in there. You have entirely just systematic risk. Because of that, because you can easily eliminate this risk, William Sharpe says, you as an investor should not get paid any risk premium for taking on that risk. Now, I might take EXC, and I'll look at it and say, wow, 21.6% standard deviation. I'm going to use a 12% discount rate to value this stock. And I do it, and I get a stock price of $3. And I call up my broker and say, I want to buy EXC, but I want to buy it for $3. And you don't call your broker anymore, but let's pretend like you're still calling your broker. And your broker says, $3, it's trading for $46. Yeah, but my assessment of risk is this is a really risky stock. I'm putting my entire portfolio in this company. So for me to buy the stock, put all of my money in this one company, I need to buy for $3 to cover my risk. And your broker's can say, well, that's fine. I can't sell it to you because everybody else buying this stock has the stock in a well-diversified portfolio. They're using a 7% discount rate. And because of that, they're getting a $47 stock price. You're getting $3. And you say, yeah, but I'm going to put all my money. It's like, that's your choice. Put all your money in one stock. But you're going to be taking this risk, 21.6%, not the risk that is measured by betas. So your risk assessment is much, much, much higher. What if you're in the HE Buck family? What discount rate to use for HE Buck? Can you put HEB in a well-diversified portfolio? It's a private company, doesn't have stock. What discount rate you use for HEB? You'd probably use 15-20% discount rate. That means the Butt family, when they value HEB, they might get $300 million. But if HEB goes public and now it can be well diversified, now your discount rate falls. So now instead of HEB being worth $300 million, suddenly it's worth $25 billion. What happens when we have a whole bunch of butts out there? I don't know what generation we're at. Probably the grandkids. Who was the founder? How many years ago was that? The original butt? Anybody know? Anybody work for HEB here? You know what the original? I'm one? Oh, wow. So there must be a bunch of great grandkids now, right? Well, if I were in the Butt family, I would want to go public because if they go public, my wealth goes up 20, 30 fold. Because instead of using a discount rate for a firm that can't be well diversified and suddenly can be, the value of the firm goes. Remember, just like here, if it's not well diversified, the stock's worth $3. I can put it in a well diversified portfolio, use it at lower discount rate. Now the stock's worth $46. Why isn't HEB going public? They may be so wealthy they just don't care. And say we're happy where we are, but eventually you want to go public. That's probably why Zuckerberg went public. He probably didn't want to go public with Meta because of all the hassle having to deal with stockholders and boards, but his wealth, goes up quite dramatically. So William Sharp is actually saying, when you look at a stock, ignore a huge percentage of its risk, because that just disappears in a well-diversified portfolio, and your discount rate's going to be much lower. Pretty earth-shattering idea, not to say that stocks were mispriced before then. I like William Sharp's approach is when he comes up with a theory, he then asks the question, what if everybody in the market used this theory? What would the market look like? Which is a good way to assess his. We saw with EXC that 93% of its risk actually disappeared. But for a typical stock, 75 to 80%, 85% of the stock's risk is unsystematic. And all you do is you just calculate the R squared between the stock's returns and the S&P's return. That's the percentage that's systematic risk. 1 minus that is the percentage that's non-systematic risk. All right, so you still don't know what this has to do with our question, but you got to set all this up. You got to explain what CAPM is, talk about systematic and unsystematic risk, talk about unsystematic being easily diversifiable. I remind you of the beta formula, which is a pretty easy formula. So what does this have to do with insurance? So the question with insurance is, are the risk that that corporations, not insurance companies, the risk that corporations are insuring, are they systematic risk or unsystematic risk? And I'm going to argue that most of the risk covered by the insurance industry are unsystematic risk. The risk of a fire, some pollution thing, some big liability hit, some cyber attack. Most of the risk covered by the insurance industry are unsystematic risk. What did I just say about unsystematic risk? They disappear when you diversify your portfolio. So theoretically, stockholders are better off if you don't buy insurance. Why? Because they've already eliminated that risk through diversification. Now, there are some insurance products that could have systematic risk. We talked about directors and officers. Remember, it's highly correlated to the stock market. When the stock market crashes, those claims go up. So that's one that has a systematic aspect to it. Obviously, a huge terrorism event like 9/11 can drive markets down and can be very, very systematic. So if you're insuring that, there are some, but most insurance covers unsystematic risk. And CAPM would argue, don't waste your money, because remember, when you buy insurance, you're paying for more than what your expected loss is. Why would you pay extra money to eliminate a risk your stockholders have already eliminated by diversifying their portfolio? But let's get even crazier. What about those insured risks that are systematic? Should you insure those? Should you insure your D&O insurance? All right. So we said for unsystematic risk, stockholders say, no, we can eliminate ourselves through diversification. For the systematic risk, the problem with the systematic risk is you have both the company that is insured and the insurance company in the same portfolio. Now, this is the most complicated thing to try to explain on the exam, but let's see if we can do it. We don't have much time, so we may have to do it twice. I call it expense leakage. Just be aware that expense leakage is my term. Don't use it in an interview. They'll have no idea what you're talking about. But it's a good way to understand this industry on the corporate side. So let's say we have the insured, maybe it's Walmart. And let's say the insurance company, let's say it's Chubb. Walmart makes $1 billion in revenue. Chubb has $500 million. Walmart's expenses are 800. Net income 200. Chubb is 400 and 100. All right. If they have a loss of $500 million, an insured loss of $500 million, their net income would fall from 200 to minus 300. Chubb doesn't have a loss, so their net income is the same. So what happens to your portfolio if Walmart has a loss? Your portfolio, instead of making $300 in income, 200 plus 100, you're instead going to lose 200. So Walmart, without buying any insurance, that $500 loss is going to flow directly into your portfolio. All right. What happens to your portfolio if Walmart buys insurance? You have both Walmart and Chubb in your portfolio. So everything's the same. Let's say they insure a $500 million warehouse and they pay $50 million for that. What happens to their net income? They were making $200 million, but now they pay $50 million in premiums. Their net income does what? It's going to fall to 150. Everybody see that? Without the insurance, it was 200. With the insurance, it falls to 150. What does Chubb's revenues do? They were making 500. Now Walmart's paid them 15 million bucks. So now their revenue's up. But what happened to, anybody notice anything happened to their expenses? They increased. Why? Because they have underwriters, they have claims adjusters. So they have some expenses. So their net income doesn't go up 50, it only goes up 30. Walmart's net income goes down 50, but Chubb's only goes up 30. So what happens to your portfolio before the loss? You were making 300. Without a loss, you're making less because Walmart paid 15 million bucks, but Chubb only got 30 million of that. 20 million went through their employees. What if they have a loss? You can say, yeah, but with a loss, that would work. Well, let's think about that. Walmart makes $1 billion in revenues. Their expenses are 800. They pay 50 million in insurance. They have a fire. Chubb pays for the fire. They make 150. You're saying, wow, I'm so glad Walmart bought that insurance. Chubb has revenues of 550, right? The original 500 plus Walmart's premium. Now their expenses are what? They're not 420. What are they now? Because now they got to settle a claim. They have claims adjusters, so they have an extra expense. And they have to pay the loss. Isn't that for your portfolio, just left pocket, right pocket? So Walmart lost 500 million bucks. They get 500 from Chubb, but you lose 500 million Chubb. That's a wash. What happens to the overall earnings of your portfolio? Remember, without the insurance, those two companies would have had a loss of $200 million. What happens with the insurance? Those two companies lose 250. Why is that? Because Chubb had to pay $50 million to their employees to manage this book of business. That's why I call it expense leakage. Remember, insurance costs you more than what the loss coverage is. So when companies buy insurance, essentially all you're doing is you're having the insurance industry hire more workers to handle something that's just going to end up being left pocket, right pocket. There's no way for you to come out ahead. So even if you're covering a risk that you think is systematic, now some students say, well, I'll just leave Chubb out of my portfolio. That'd be kind of a strange thing to do. Just for this one particular item, you probably want a well-diversified portfolio. Doesn't make a lot of sense. But that's what I call expense leakage when you have a portfolio that has both the insurance company and the insured in it, there's no way to come out ahead. The claim payments just go from one company to the other. They just cover each other. And then the insurance company has all these expenses they've got to cover. So theoretically, corporations should not buy insurance. There's just no way to come out ahead. First of all, they've already eliminated risks just because not they. Now be real careful. I'm glad I messed that up. When I say they, be real careful in the exam. The they here is the stockholders. That's going to be important when we talk about the true answer here. The company can't eliminate this through diversification, right? The company is the company. They're exposed to all the risk. We're talking about the stockholders who own the company. They can eliminate that risk because they own a bunch of different companies. The company itself does have this risk and they are exposed to it, right? So be real careful. We're not talking about the company. The company cannot eliminate unsystematic risk through diversification. The stockholders in the company can, all right? Have that real clearly in your notes. And even if it's a risk that can't be diversified, things like D&O insurance, even then the stockholders are not any better off because it's just left pocket, right pocket between the company and the insurance company. And this is the way I like to summarize it. You don't want management spending precious corporate resources to mitigate a risk you, the investor, already mitigated through just diversifying your portfolio. You've already eliminated that risk. Why spend that money? I love this question because it brings in what you've learned in finance and other places. CAPM does have this application. That's why I get back to William Sharp when he said, hey, if everybody used my theory, CAPM, what would that imply for investing? This is one of those implications. Insurance makes sense for individuals, but doesn't make sense for corporations. But the easy part of the question, corporations buy a lot of insurance. So why is that? And I somewhat alluded to it. First of all, there are other stakeholders in the company besides just the stockholders. And who are those others that may not care about CAPM? Well, lenders, bondholders, banks. They don't care about CAPM. You think about CAPM, why does CAPM work? Because if you have a stock and well-diversified portfolio, bad news at one company might lose you 30%, but good news in another company might make you 30%, they offset. If you're a bondholder, what's your upside? Whatever the coupon is, right? 6%. But what's your downside? You can lose 100%. So with the bondholder, they have someone lose 30, 40%. There's not another bond that's up 30, 40% because they have limited upside and all the downside. So they don't care about CAPM. They want companies to insure because they don't want to be having 100% losses. So banks and bondholders are saying, hey, you better buy insurance. We don't want your bond going insolvent because you didn't insure your company. Employees, how many companies can you work at one time? Can you diversify your employment? Can you go out and work for 50 different companies? So if one goes out, another one's doing really well and pays you a bonus. Some of y'all probably do have 3 or 4 employers, but probably not 50 spread around the country. So employees can't do that. They want their employer to have insurance. So that something goes wrong, their company doesn't go insolvent just because they didn't buy insurance. And probably even more importantly is senior management. Senior management has a lot of exposure to the company. Their bonuses, their stock options. That's what we call the agency problem. Management may not always be seeking what's in the best interest of stockholders because they're worried about their own particular risk. And so they may actually buy insurance because they don't want the company to go under during their watch because they have 90% of their wealth is in this one company. It's hard as management to really diversify all of that risk because, again, you can only work for one company at a time. And this agency problem actually gets worse if you make management own more of the stock because they're more concentrated exposure to that stock. They worry more and more and more about big events happening that they want to buy insurance for. So it's an agency problem that I think the stockholders have just accepted. Management's going to buy insurance to cover their own risk. We'll just let them do it. It's not a massive part of the cost structure of a company. It's expensive, but it's not so expensive that it really impacts our portfolio that much and makes management happier. So we'll do that. Vendors, some vendors will require you to have insurance or they won't do business with you. Regulators, they take all the downside, not the upside. They don't want companies they regulate to go insolvent because they didn't buy insurance. So, all right, on the exam, we'll start here and finish this up. But on the exam, I'm going to ask you to give me 2 or 3 examples of why they do buy. So this list, and we'll go through the rest of them next class. So a couple things you could do is this week is write your paper 1, get it done, and also start drafting out this essay while it's fresh in your mind. So, all right, any questions on anything? We've covered some really key concepts. Hopefully you're remembering them. So we talked about, we're going to get into this. What kind of risk can an insurance company covers? So what did anybody remember the 6 things off the top of your head that Warren Buffett said? Real quickly, top of your head. I know y'all know it. Number 1.
Like be able to evaluate the risk.
Yeah, be able to evaluate in terms of, what was those 2 things? Frequency, severity. All right, that's 1. So that's the evaluation, frequency and severity. Expected profit, not every year, but over time. Yeah, avoid immoral people. That applies probably to all industries.
Market share.
You give up market share if your competitors are mispricing. Say it really loud. Yeah, okay, we got that. Don't deal with immoral people. That's 4. What's the last one that's the hardest? Yeah, experience versus exposure, and the 2 times experience can hurt you. That's really, really critical. If I were doing an interview with an insurance company, I would bring what are those 2 places experience can really hurt you when experience. Yeah, really low frequency.
Things change.
When change, the distribution is changing. All right, so we got 5 of the 6. Yeah, the aggregation, make sure you don't get the aggregation risk, especially in a way where you have this correlation that suddenly appears. We see that sometimes at the extremes. Our risk management class is going to talk about this. This is something that Doug Hubbard talks about, which is this contagion effect. Things are normally uncorrelated, but at extreme, they suddenly become all correlated. You can probably say 2001 was in an extreme. So, all right, so good. And then last class, we're talking about should corporations buy insurance? And what did the capital asset pricing model say? Really shouldn't. Why? Because there's 2 types of risk, systemic, unsystematic. Most insurance risk are what type? Unsystematic, which means the stockholder doesn't care, right? They eliminate that risk by simply diversifying their portfolio. But even for the couple that might be somewhat systematic, like directors and officers, and maybe a huge event like a terrorist event, even then, because remember, insurance, it costs you more than what you're expected to get over time. When insurance companies sell insurance to other companies, it's just a left pocket, right pocket, plus all the expense of the insurance company. And so here's the rubric for the question on the exam. The 4 reasons why they still buy insurance is a big chunk of it. But the real key is understanding the unsystematic risk part and the fact that insurance costs more than the expected. So from a net present value standpoint, it's a negative net present value.
When it's a stat and formula, is it like the entire explanation that we went through on Monday, or is it literally just?
On that one, I just want to see the formula, but you're going to explain it when you explain systematic, unsystematic risk. All right. You must say I'm an actuarial science major. Actuaries know CAPM as well as finance people. When I was doing CAPM with UTSA, the P&C actuaries, they knew CAPM as well as I did. They studied, it's got to be on the actuarial exams as well as they knew it. They were explaining it, they knew it as well as I did. Not better maybe because, hopefully finance people know some stuff in finance that actuaries don't know, but they knew it extremely well. All right, so that's the kind of things I'm looking for, but it's got to be a full explanation. I'm leaning toward the exam being all in class, so 2 math problems in this essay, but I'll let you have the rubric, but nothing more. So I'll put the rubric in the question so you at least have the rubric, but I want you to explain it. I know writing is really tough now. Your hands just can't, you're all typers now. But I might actually, what I'm thinking about doing is having you do the essay in class, but kick out one of the essays I normally ask. And so we'll see. There's another essay I like to cover, but it's not as critical to me as this one. This one's pretty important to understand how insurance for corporations work. So where we got to last class, well, and then we asked when should individuals buy insurance? What was the key there? Low blank and high blank. You remember? Low frequency, high severity. Why? Because when you buy insurance, it's a losing proposition. The low frequency keeps the cost down because you don't have the insurance company with a massive number of people. The high severity is you want to say, on average, I'm better off not buying the insurance, but I can't take that 1 year when I lose 50,000 bucks. So I'm willing to pay more than expected loss. But if it's low severity, definitely don't do it. Just pay it out of pocket because insurance is a losing proposition. All right, so we finish up by saying corporations do buy insurance. Part of it is CAPM assumes is from the stockholder standpoint. And remember, that's really critical. Don't use the word they and make it unclear whether you're talking about the corporation or a stockholder. We're talking from the standpoint of the stockholder. The corporation is a different entity. From the corporation standpoint, there's other stakeholders besides stockholders. There's lenders, there are employees, especially senior management. There's vendors, there's regulators, there's other people who don't have the upside that the stockholder has. So the stockholder is well diversified because of unsystematic risk causing them to lose money. They'll have an unsystematic risk causing them to make money. These people don't have the upside. They just have the downside. So they're going to be pretty emphatic that companies buy insurance. So the second, remember again, on the exam, you have to give me 4 of these. I count this as 1, and this is one you should put in there because it's the most important one. Of the remaining 4, pick 3 of them, or remaining 5, pick 3 of them. Insurance companies do add value to corporations. They're very good at loss control. When they show up, they can tell the company, hey, you should stop doing that. You should be doing, so they can actually help the company save money just because they're very, very good. They know their business extremely well. I've dealt with some small entities dealing with insurance companies where they said, you know, you guys really should look into doing this, whether it has to do with theft or any of those kind of things. I mean, theft today, you know, these cameras are really cheap. You can put up cameras and other things. Sometimes you can just put up a sign and say you have a camera and it has a huge impact. So this loss control, and the key to this one is the value added by insurance companies is this loss control. And if you follow that, you have two benefits. First of all, your insurance premiums come down, but secondly, your actual losses come down, which is why your premiums come down. So you might net, even though you're still paying more for the insurance than what your average loss is going to be, you may actually, they save you enough money on losses that you actually come out ahead. The second thing they have, insurance companies provide, is essentially an outsourcing. This is especially true for workers' comp. And I saw this at UTSA. I worked in workers' comp for 7 days. I took a new job, and when I did, my previous boss wanted to leave his job, and they wouldn't let him leave unless I came back. So I worked 7 days in workers' comp, and then I went back to my old job. But workers' comp, there's a lot of claims. There's people out sick because they got injured on the job. And the corporation may not want to hire people to handle all these little claims. They may just say, hey, let the insurance company handle these. And so it's essentially an outsourcing, a claims administration. Let the insurance do this stuff. Why? Because they're really good at it. They have economies of scale. They have highly trained people. Why in the world would you hire all these people to handle all these workers that are out sick or are out injured when you can hand it over to the insurance company? So I saw this at USA. We'll talk about workers' comp much later, but the biggest workers' comp claim when I was there was carpal tunnel. It's not as much today, but computers, people were just getting injured. And so one of our insurance companies, they had a guy that his entire expertise was the human hand. He was a hand expert, which sounds really bizarre to me, but that's what he helped people handle those carpal tunnel things. You don't want USA hiring a hand guy full time, but if that person goes around and helps and can help you, how do you structure the desk? It got really irritating at USA because you go sit at someone else's desk and it's like 2 feet off the ground, and somebody else's is 6 feet off the ground, and you're banging your knees and all that. But they were real careful during those times of how are we going to protect workers from that. And it saves USA money because that's a very specialized field. Another area is insurance, especially if you're a small business or doing business. They give somewhat of a confidence to other like customers and investors. This is a legitimate business. They can buy insurance. They must be a legitimate business. I started a consulting firm for a short time. We had to buy the insurance. It was pretty expensive, but having the insurance gave us some credibility that we were a legitimate firm. More important for small companies and new companies, but definitely the insurance company is not going to insure you without making sure you've you've done the necessary analysis, covered risk, especially, for me, a consulting firm, I don't want to be sued, and they want to make sure my contracts are set up correctly before they insure me. So it gives some credibility to my business. The next one, in which I think is actually maybe the most important or second most important one, is taxes. Insurance is favorably taxed. So last class, we talk about this expense load example. When the company buys insurance, that's tax deductible immediately. The insurance company, though, gets to spread out the losses over time. So you think about this company, all they can tax deduct is the insurance premium. When they have the huge loss, the $500 million loss, they can deduct that, but that might wipe out their entire income, so that they don't have any taxable income, and they have to spread that to future income or spread it back. So they may not get the tax deduction. The insurer, because they're insuring a lot of people, they get the tax deduction pretty much spread out, which is what you want. So essentially what happens, the insured has a disadvantage on the taxes because they only get to deduct the insurance premium. The insurer gets to spread out a lot of taxes, a lot of losses over time. So they essentially get to move those losses forward. So there is a huge tax advantage. We'll talk about captive insurance companies. There is some insurance where the only reason it exists is for the tax law. If you hear about a captive insurance, that's an insurance company only has one customer, and that's the corporation. Why would they do that? They do it for taxes. It allows them to spread the taxes out. So insurance companies price policies instead of reserves, and they get to take tax deductions based on the reserves, not when they actually pay the claims. They get tax deductions much, much earlier. And then the last one is regulatory costs. Utilities are a good example. So utilities, they have a rate base, they have expenses. If they didn't buy insurance, then a major insurance loss wouldn't be part of their rate base until that loss happened. But if they buy insurance, they count that as their cost. They get a cost plus on top of that. Can you think of any utility with a major insurance loss right now? I can't spell. PEG, utility, lawsuits, fires. I think it's PEG. PG&E. Yeah, I probably just can't. Is that right? It's an E. How much are these losses? 100 million settlement tied to deadly Northern California fires. So if they didn't buy the insurance, and the insurance will probably pay a big chunk of that, if they don't buy the insurance, then it's not in their rate base. That $100 million hits. I don't know how the regulator is going to handle it. That may ignore it, but if they're paying $10 million in insurance premium, that's part of their costs. Utilities get to take their costs and add a profit on top of that. So it helps them, again, spread that out over time. 100 million doesn't sound like that much, so there's probably more to come on that. All right. So for right now, assume that is your major essay for exam 1. You can start working on it. I don't remember when the exam is, but let's look. I get my classes mixed up. Do y'all know? Do y'all keep track of that? Oh my word, it's like 3 years from now. So not until after spring break, but so your paper 1, keep focusing on that. But if I were you, I would start drafting out. Given that you're going to do it in class, it's maybe more of write it out so you have your kind of organize your thoughts and you're ready to go. All right.
So I have a quick question. We're not allowed to bring a pre-draft though, right? Surely into the exam.
No, I'll give you the rubric.
Gotcha.
Yeah, I like this question because it really makes sure you know CAPM. So that's something you should know already. And I'm really amazed. I used to interview a lot of people, including Ivy League MBAs, and I'm shocked at how many finance students can't talk more than 5 seconds on CAPM. It's shocking to me. It's the most important theory and then the entire history of finance. You should know it backwards and forwards. It's on the CFA exam. But for somehow, and I think the problem is you see it every class, but every professor does it slightly differently. So it's just not sticking. And you should, I mean, literally, it sounds like exaggeration. You should be able to sit down 20, 30 pages off the top of your head just talking about CAPM. You should know it that well. It's that important of a theory, and you should be able to explain it. I remember talking to a Yale MBA student. He was highly put, I mean, this guy's just genius. Basic question, and I'll just say, "Hey, explain CAPM to me." And it's like, yeah, he had no clue. And so I like it from that standpoint, but it's also really important understanding. I don't want to assuming insurance is the same for individuals as is of corporations because it's not. It's a very, very different animals for corporation. So even though corporations do buy insurance, it's still quite different. They do retain a lot more of the risk. They do a lot more kind of self-insuring than individuals will. So it's a very, very different market. All right. We said the third question is when can the insurance industry provide insurance? I'm going to give you the textbook answer, but you can see a large overlap with this and what Warren Buffett said. And the first one's right on Warren Buffett's list, isn't it? Ability to evaluate the risk in terms of frequency and severity. That's definitely there. Some are very easy. Life insurance, we have really good data on when people die. Obviously, COVID changed that, but not dramatically. It changed it some, but we have pretty good data when people die. What happens in the next pandemic? I kind of wonder about the next pandemic because I think COVID has made pandemics quite political, hasn't it? Can you imagine next pandemic, what's going to happen when they tell us to wear a mask? I've seen the video, right? The person walking in Walmart without a mask. I mean, it becomes this big thing. I'm not going to say, what argument I have either side, how valuable masks are or not. But can you imagine next time our government says, you can't do this, you can do this? It's going to be a firestorm. And the next pandemic may be much worse. I've been seeing these videos. There's a pandemic starting in some parts of the world right now that look pretty serious. Who knows? But so that could be huge. Car insurance, we have really good data on that. But then there was a year when the federal government, I don't know if y'all realize this, there was a time where the federal government imposed a 55-mile-an-hour speed limit. Any of y'all ever heard of that? The highest speed limit in the United States was 55. Why did they do that? Any guesses for that? What were they trying to do?
Reduce accidents?
Had nothing to do with people dying. Huh? Huh? Wasn't any emissions. What was going on in the 70s? Fuel prices. It was to get us to use less fuel. Can you imagine people in Texas driving 55 miles an hour? And most of them didn't. They still go by 90 miles an hour. So what happens to actuaries when they change the speed limit instead of 55 and each state can set their own? They've got to somehow get the data. Do they have data from the 60s and 70s? What do you do? Some of y'all picking your second paper, a really, really good paper, is how the insurance industry has influenced the safety of cars. Seat belts, airbags, anti-lock brakes, side airbags. It's pretty incredible how, and I'll show you a website that does a really good job with this. So the insurance industry has influenced, but they don't influence everything. So definitely speed limit changes. Another issue they had was, and they don't always get it right. So people started buying these huge vehicles, these sports utility vehicles. And the insurance industry initially said, well, that's good because these things are so big, they don't get that damage. But what did they find out? Well, Part D insurance came down, the comprehensive collision, but what went up? The Part A, the liability side. these massive vehicles were hitting these small vehicles and causing a lot more damage. And so they had to say, okay, how do we adjust those two? So you learn over time. It was interesting. I don't know if I talked about this yet, but at USAA, they started insuring the enlisted market. Did we talk about that yet? I can't remember. So USA used to just insure officers and their families, and then they started coming down to the E's. I don't understand military all that well. And their assumption was military officers are really good drivers. Gave USA a huge advantage on auto insurance. And their assumption was when you came down to lower levels of officers that they were good drivers too, just as good. Why? And their thought process was the military essentially underwrites for them. Because if you're in the military, you have a DWI or you're a bad driver, they're going to cause you problems. What did I discover? They weren't very good drivers. They weren't nearly as good a drivers as the military. And so USA started insuring all these people and then discovered that their claims were much higher. It's interesting, the life insurance side, what did they discover? Those men and women were very healthy like the officers. The life insurance side loved it. They didn't die very much. They didn't drive very well, but they lived much longer. They're very healthy. But the car side didn't. So generally, we have really good information here, but actuaries do get surprised every once in a while. Things do change. They have to be aware of that. Homeowners, we have good data, but there's a fear about global warming. Is it impacting? Is it not impacting? We'll look at that a little later when we look at the NOAA's data. But it's a little tough. There's some that require very specialized skills, boiling machinery, just specialized equipment that you have. Very few insurance companies sell that because you need to have actuaries that know that stuff extremely well. And then there's some, as Warren Buffett said, that may be very difficult. Terrorism insurance. Cyber risk could be your paper two topic. It's a very interesting topic now. Can the insurance industry insure cyber risk? What do you think is impacting cyber risk right now more than anything else? It's two letters. AI. I've been seeing a lot of these identity thefts and other things. One guy, a video, someone called him and said it was his dad and needed the password to the bank account, and he said it sounded exactly like his dad. The only thing that saved him is his dad had died 20 years earlier. But that's pretty freaky, right? And how many words of you do they need to replicate your voice? Doesn't take much, does it? And where do they get all that? From your Facebook and from your Instagram, right? So that's pretty scary. What is cyber risk going to do going forward? That's really scary. Flood, not insured by the insurance industry anymore. Earthquake is insured, but there's a good chance earthquake will become less insured as it becomes more a risk. So yeah, we need to have data. This has both of those things we talked about. Some of these, we just don't have much data. Others, the world is changing. Cyber risk for paper one. You're trying to find a second example. Cyber risk might be a good example where the world is really changing because of AI. So that historical data may not be that useful because the fraudsters are getting a whole lot better. My risk management class, I think it was last Thursday, I got a phone call in the middle of the class, or was that Tuesday? I can't remember. But it was a fraudster calling me to tell me that, I needed to settle a tax dispute. It's like I'm quite confident I don't have any tax disputes out there. All right, the second one wasn't on Warren Buffett's list, but that is that you need to know when you have a claim. It can't be wishy-washy. So life insurance, how do you know you have a claim? You need a death certificate. And the amount is obvious. So you need to know the claim happened and how much the account claim is for. For life insurance, a legitimate claim is there because you've had a death certificate. The amount is obvious because life insurance is a valued policy. You tell the life insurance company what the severity is. You buy $100,000 coverage or $200,000 of coverage. What's one exception on this is double indemnity. Anybody know what that means? So double indemnity, if your policy is 100,000, they'll pay you $200,000 if the person died in an accident. That's still indemnity. So there they have to do a little more research. There are some really amazing, in fact, if your significant other buys life insurance with double indemnity, be ready for a horrible, horrible, horrible end into your life. Those are the worst stories out there. Why? Because what do they got to do? They need you to die, and they need you to die in what looks like an accident. And so they got to set it up. I think I told my life insurance class about a lady who poisoned her husband, and he died, and she wanted to make it look like it was an accident, but they assessed it as a heart attack. And so what did she do? She poisoned someone else to make it look like it was part of the a poisoning thing that was going around, and she actually killed the person. Yeah, yeah, the aspirin. She wanted to make it look like her husband died because there was a poisoning going on, Tylenol or whatever, and they didn't catch it. They thought he died of a heart attack. She ends up killing another person just so she can make it look like. And why was it? It was all about double indemnity. So there are times where life insurance can be really tough. You can't murder the other person and collect the life insurance if they find out that you killed the person. So there is a little bit there, but tends to be fairly straightforward. Auto insurance, you got to file a claim. You need evidence of the claim. You got to be able to show that maybe you need a police report. There may be bills from mechanics or hospitals for auto, home, health insurance. This is indemnity insurance. So what they're doing here is they're reimbursing you. It's very different than life insurance. If there are very few valued policies, there's a couple of them in property and casualty side, but most of them are indemnities. So it's rare. You're not gonna have an auto policy. Hey, if I have a wreck, pay me $20,000. That just doesn't exist. They're gonna look and see what you actually lost. So it's a little bit more work. It's a little more expensive. They have to have more people there to handle the claims. A good friend of mine did the life insurance side. His department was pretty small. There's like 4 or 5 of them in the department. You go over to the property and casualty side, it's hundreds of people. It's a huge department. So that's the second one, not on Warren Buffett's list. Insurers must be able to control their exposure to non-accidental events. So it means the losses need to be fortuitous and accidental. They cannot be intentional. That again is kind of not in Warren Buffett's list, except for what he said, don't deal with unethical people. There's a difference between moral hazard and morale hazard. Moral hazard is when you intentionally cause a claim in order to collect on the insurance. And that is illegal. Okay, let me see. Yes, oh, sorry. I'm worried about. So that's intentional. So someone burns down their house to collect on the insurance. That you've got to, it can be tricky here. There is a case where a man burned down his house to collect on the insurance. The insurance said, we don't cover you because it was intentional. But the wife said, I'm uninsured. I didn't burn the house down. I didn't know my husband was burning the house down. You can't pay him to claim, but I lost the house. And so that went to court, and that was the debate. Can she get paid as an insured if her husband, so the contract said the insured can't collect if they intentionally cause a loss. There was more than one insured. She's arguing, no, I should get paid because I didn't burn the house down. That would be illegal. A few years ago, a car dealership had this advertisement. They had this really great deal. So they showed people pushing their cars off of 5-story tall parking garages, essentially saying, hey, intentionally destroy your car so you can get the insurance and buy a new car. And the insurance industry called this dealership and said, stop doing that. That's illegal. People can't destroy their cars to get the insurance. So that's illegal. There's some interesting cases out there at USAA. There were a lot of cases that you will go to jail if you do this. There's one guy at USAA, they went to his house to help finalize his claim. He had been robbed. He wasn't home, but they had his mom's address. So they go to his mom's address and say, hey, we're just looking for him. Want to finish this claim. She goes, he's not here, but all this stuff is in my backyard. All the stuff that had been stolen was in her backyard. And they're like, okay, that's fraud. You're going to go to jail. Morale hazard is a little bit different. And this one's really, really unique, and it's especially related to auto insurance. Morale hazard is when you buy insurance, you start acting differently. You become riskier. The insurance causes you to be a riskier person. So a good example be you buy a $100,000 car, you get into it, and then you realize, oh, you know what? I never bought auto insurance. I don't have any auto insurance on this $100,000 car. How do you drive home that night? You're pretty safe, right? You see another car coming towards you, you get off and park. You sleep in the garage with your pit bull all night, and you have it locked up. You got lights on. The next morning you call State Farm, you buy insurance. Do you drive differently the next day? You do. You're a more dangerous driver. So buying insurance makes you a riskier driver. This is not illegal. This is just the nature of humanity. Insurance companies know this, so they actually charge you more. Seems kind of circular. If you didn't buy insurance, you'd be a safer risk. The second you buy insurance, you become riskier, so they're going to charge you more. Sounds kind of circular. Definitely applies to auto insurance. Does it apply to health insurance? Do you think people go out and say, hey, I'm going to go bungee jumping. I got health insurance now. A little trickier, right? Because you got a lot more skin in the game. Life insurance, probably not. I've never heard anyone say, no, I can do skydiving. I got life insurance. You got a lot of skin in the game. Homeowners, I doubt as much. Can you imagine someone saying, you know what, I really should change the battery in my fire alarm, but I got homeowners insurance. I'll do it tomorrow. Maybe that's happened.
This might be for individuals, I know the corporations, you said it actually can reduce their risk.
From the pricing standpoint, definitely mainly because a lot of corporate side, the insurance actually reflects their specific risk. You becoming safer, there's no way you can convince the insurance company of that. So that's a good point. Yeah, for you individually, you don't really have any benefit saying, no, I'll keep driving really, really safely, because they're not going to believe you. They're going to account for you as your age and your risk pool. So probably this is mainly an auto insurance side. I don't think this applies to what Warren Buffett was saying. Another way this comes out is adverse selection. This really deals more with life insurance. Well, it deals with all of them. Adverse selection is people who need insurance are going to more likely to buy it and buy more of it. So unhealthy people are going to buy more life insurance and health insurance. Bad drivers are going to want to buy more auto insurance. So unhealthy people buy more. So actuaries assume when you buy life insurance that your health is below average, and they price that into the policy. They do adjust for certain things like smokers, your habits. They do have select and ultimate tables. So you can select means you just had a health exam, and because of that, they'll give you lower rates. But over time, it's been longer since you had the last health exam. They'll start raising the prices there. Annuities, they assume if you buy annuity, which pays you money until you die, they assume if you buy that, you're healthier than average. And so in that case, they're going to charge you more. They're going to pay you a lower monthly income because you bought the annuity. I asked the actuaries at USAA, what if the same person buys both of your products? Shouldn't they get a break? Because they can't both die early and live too long. And the actuaries just laughed at me, but I thought it was a legitimate question. If they buy both products, we should give them some kind of break on the premium, because otherwise they're overpaying. Auto insurance, bad drivers, and we'll talk about this more. Bad drivers will want more coverage than good drivers. Good drivers are overcharged, bad drivers are undercharged. So what do good drivers do? They buy less, which does what for the insurance companies? It causes their claims to go up, and they got to charge more, and it's the circular thing. You should have studied this article I had this article in an auditing class. Have y'all studied this article, The Market for Lemons? It's a very, very famous article. You can probably find it as a PDF online. Here it says quality uncertain and the market mechanism. He talks about used car salespeople. So what he says is if you're a used car salesperson, you have more knowledge of the quality of your cars than your clients, people coming to you. And your clients are coming and say, man, I'm going to get ripped off. They're going to be real picky. So if you're a really good used car, you're selling high quality stuff, you're not going to like it because your cars should go for a higher price, but your clients aren't going to believe you. So what happens? Good people get out of the business. The bad people stay. And what happens? The quality keeps getting lower and lower and lower. This was in an auditing class. There was this argument for why we need auditors so that we can trust companies. So this is true on the insurance side too. If insurance companies assume only bad drivers are going to buy insurance, they're going to overcharge, and it's going to make good drivers not buy insurance. So it's this asymmetry of information. And when you have asymmetry of information, markets often don't function correctly. So this is coming back to you. Any class y'all study this? So it's a pretty famous, it's a really boring article. I remember reading it in a class. It's kind of like oh, I don't know, some of these famous books you read and then you go read them. And you're like, wow, this is really boring, but there's one or two really important things in it. That's kind of that article, but it's kind of in that line. Underwriting helps that. Medical exams, questionnaires. We talk about telematics might help this on the auto side. So underwriting is where they sit down and they look at all the data they have and are now using more and more AI, try to figure out where to put you on the risk scale. So some of you, if you haven't figured out your career, underwriting could be a really great place to go. It's an interesting job. It pays well. And it could definitely be very interesting, very statistical, a lot of AI now. Underwriting might be one of those fields where AI might start replacing jobs because it definitely has. This really is just get the data and go through the statistics to try to figure out, should we charge this person more based on the data that we have? So yeah, that's very, very important component of insurance, but there's two pieces of it. The moral hazard piece and the adverse selection part of it. One way insurance companies try to control both of these is something called insurable interest. So what they want is to set up the policy in such a way that the person prefers not to have the event happen. So life insurance, you can always buy life insurance on your own life. They're going to assume you'd rather be alive than get the insurance. Health insurance, same way. They assume you'd rather not have a broken leg than have a broken leg, even though the insurance is going to pay for it. You'd rather your house not burn down than burn down. That's insurable interest. Life insurance is really bizarre. It's the only insurance where insurable interest only has to be in place on day one. After that, it doesn't have to be in place. All other insurance, insurable interest always has to be there. You can't buy auto insurance on your car and then sell your car to your 16-year-old neighbor. Say, hey, it's got insurance on it, so you're good. No, the insurance is going to say, no, you just changed the risk pretty dramatically. That person needs to buy their own insurance. But if you buy insurance on a spouse and you two get divorced and you hate each other's guts and you move to opposite coasts, that doesn't sound like there's any insurable interest there, but you get to keep the life insurance on that person. Life insurance is the one, and there are some very famous cases on life insurance where that actually became quite an issue. But yeah, if you buy insurance on a home, on a car, anything you do, you have to maintain, you have to be the risk, and the insurance is specific to you and your risk profile. That's also true if you have a car and you have family members join onto your policy. They're going to want to know who's driving this car. You got a 16-year-old, 17-year-old driving your car. That's going to change your premiums. And so you can't just add a driver There are times with auto insurance that something happens incidentally, very infrequently. That doesn't impact it much. But if there's someone who's driving your car all the time and they're not in your policy, you're probably going to be in trouble if they find out, because it changes the risk. All right, and then the last one is on Warren Buffett. So we got 2 of the 6 is here, and this is, it can't be an event that's so big it wipes out the entire insurance industry, is that aggregation of losses. So something that it may be low frequency, but the severity is so high. So flood insurance is no longer covered by the insurance industry. War risk is not covered. I say by life insurance, this war is also not covered by property is either. So if North Korea sends a nuclear bomb over to San Antonio, it's probably the last thing you're worried about is your homeowners insurance, but your homeowners may not cover it. This was interesting in 2001, because what did Bush call this thing? The war on terror. A few insurance companies said, wait, that was a war? We don't cover war. And they didn't win that case, but hey, the president of the United States says we're in war. We don't have to cover those claims. So yeah, I mean, he kind of used the wrong word there. Earthquake and hurricane is covered by the insurance industry, but remember on hurricane, it's only the wind, it's not the water. The water is flood, so that's not covered. So, all right, so we already did the paper 1 discussion. You might read through those notes to see if anything else came up. A book I do recommend, y'all probably have heard of Nate Silver. He's pretty famous on prediction markets. Have any of y'all read this book? I don't want to continue shopping. The Signal Noise, Why So Many Predictions Fail, But Some Don't. So it's a good book. Statistics is really huge for insurance. And so understanding, actuaries especially understanding when they get something wrong, going back and assess. We'll talk later, well, here pretty soon after we do homeowners, we're going to talk about catastrophe risk. These catastrophe models, why did they get it wrong sometimes? Really, really wrong sometimes. Like Hurricane Andrew. Their estimates on Hurricane Andrew, which happened like 30 years ago, they thought it was going to be maybe a $300 million event or something like that. Ended up being much higher. Why? They didn't realize how much it costs to pay for people living in apartments for an extended period of time. When you have that much area destroyed, you don't rebuild houses in 2 or 3 months. You've got a limited supply of workers and equipment, and so they had to change their models. So it's essentially what actuaries are doing is they're learning as they go. Each loss, every event is new data for them to work on. The best actuaries are the best statisticians. A good statistician knows where the data is, gets the data, does the stats correctly, is always second guessing themselves. So that's what actuaries do. It's a really fun job, I think. It would be pretty cool job. You're just sitting there doing math all day, but in a way that absolutely can add tremendous value. We'll talk about credit risk. Some actuary out there discovered a huge correlation between credit scores and how well people drive. That is like a dream situation for an actuary to discover something like that. As critical as that is, that's huge. All right, so some good intro. Let's talk about the industry itself. So insurance is part of financial services. Financial services is banks, investments. This is also called capital markets. Real estate has been moved to its own sector, but real estate really is part of financials, and then insurance. Insurance is broken up between life insurance and property and casualty primarily. On the life and health side, they have individual products and group products. So group product is you go work for UTSA and you're paid $80,000. They're going to give you $80,000 of life insurance. 1 times your salary, that's a group policy. And they actually underwrite it themselves. They sell it through their life insurance company. So that would be a group product, or you call UTSA and you buy your own product, that'd be individual. They don't have personal and commercial, they have individual and group. The property casualty side, they have personal lines, and they use the word lines. I don't know why. Life insurance doesn't use the word lines, but the property casualty side, personal lines and commercial lines. And then they break it up between property, liability, sometimes called casualty. In fact, we call this the P&C industry, casualty, property and casualty insurance. The property side is primarily hot auto, home, and other properties. The liability side, they break it into several different pieces. We'll talk some of these. Workers' comp is its own thing, and workers' comp, so health insurance used to be in the property casualty side. And I should have brought it up here. I did. So now health insurance is in the life insurance side. It used to be property casualty side. Now it's on the life insurance side. But workers' comp, which is primarily health insurance, remain on the property casualty side. In my mind, health insurance looks a lot more like property and casualty than it does like life insurance. But it's kind of now most health insurance is just health insurance. We used to have companies that would sell life, annuities, and health. Now the health insurers really just do health insurance. So the industry is really changing. But the property and casualty side does do workers' comp. There are companies out there that do nothing but workers' comp. But they would be considered a property and casualty insurance company. And there are others, title insurance. I haven't contacted my contacts here on the commercial side. One of the women, the woman that spoke at our event last year, she talked about some really weird policies they were doing, but she wouldn't divulge what they were. So I'm going to see if I can't get her to divulge what they are and see how interesting they are. There are some interesting policies out there on the commercial side, especially not so much on the individual side. If you're an actuary, where do you want to work? So where are most of the jobs? P&C, definitely. I would rather work on the life insurance side because the life insurance side is much more closely tied to the investment side. So you get the investment and the actuarial side. I love the P&C actuaries at USAA. They were my favorite people. They were so nice to me. I always felt so smart around them because they pretended like I wasn't stupid. They like, oh, good question, Ron. But smart people. I love just very analytical. The life and actuaries, I liked working with them as well. They're just a little stranger. When you're dealing with death and dying all day long, you're maybe a little bit different personality, but really good people. I loved working with them. I know several of them still. There are more jobs here. USAA does hire a lot of our actuarial science majors. I may have a couple of them talk during the semester. I'm pretty sure I can get, there's 2 of them there that are really, really good actuaries. I had one other, I tried to contact him and discovered that he quit his job as an actuary, and he and his wife have some online chat group or something, some influencer. So I guess actuary wasn't making him as much money as he wanted. I don't know many life actuaries because they all retired. They're all my age and older, so I can't introduce you to them, but they have hired a couple of our actuaries, but not very many. They don't have that many jobs. Workers' comp, you could specialize in that, definitely. I don't think title insurance is a heavy actuarial field, but P&C is where most of the jobs are. It is an interesting area. It's incredibly specialized. So the actuary side, there are pricing actuaries. I forget our 2 UTSA students. I forget exactly where they are. The one who quit, he was doing the fire policy, which is a very unique policy. You would think fire would be under homeowners, but he had a policy that was specifically just for fire, for special type of houses. So it was interesting. A lot of pricing actuaries, they're the ones who are going to sit down and figure out how much to charge 24-year-old drivers in Montana that are male drivers. That's what they do. They go to the state, get it approved. So that's the pricing actuary. Reserving actuaries, not as many of them at USA. That was Mary. I wish I could find Mary. She's probably retired by now. But talk about the job as reserving actuary. She was really incredible. She was extremely picky about her numbers. She wanted them to be absolutely perfect. I loved working with her. I mean, just it sounded like a great job. Reinsurance, catastrophe actuaries. I haven't decided yet if I'm going to ask him to speak to the class. He's spoken to this class the last 2 times. He was one of the leaders in the industry, but he retired. So maybe I will. We do it by Zoom. He's very, very interesting, very, very knowledgeable. So we'll see. We'll kind of see how the semester progresses. We lost that one class, so we'll have to see. Pretty critical for a company like USAA because they're the ones that are going to decide how much risk they're going to retain. Should they get a reinsurer to come in? They do have product development. I don't quite understand that at USAA because I can't think of any really new product they've offered in the last several years, but product development. The investment side works very closely with the actuaries on pricing. With pricing actuaries, I did a lot of projects with pricing actuaries where my job was to help them on how much is that float making you? Are you going to make 5%, 6%? Because that has to go right into the pricing. Underwriting, we talked about that, but they work really close with the actuaries. So if you're an actuary, you don't have the exams, start in underwriting and get the exams, you can move over to actuary. It's a really good experience. Policy service. I had a good friend of mine at USAA. She was a cousin of a good friend of mine. I called her with all my auto and homeowner stuff, and I told her how to invest her 401k. So it was kind of this sharing, and she knew her business very, very well, and I knew investing very, very well. I set up this whole thing for her in 2008, how to trade her 401k, and she ended up doing extremely well in 08. So kind of a sharing there. This sounds like, it's people are calling in to change address. It's much more than that. They know these policies extremely well. They help people with, do you have the right coverage? Do you have enough coverage? Are you missing a coverage? That's really important. Very knowledgeable people. I found her very, very valuable to talk to. You do have sales sides. There can be commission salespeople on the P&C side. That's more common on the life side. Claims is another area that you really learn the industry. It's one of the toughest places to work because you're getting people that are calling that are really upset. They have the normal staff functions, and then the unique thing is they have usually a regulatory department. And those can be massive at USA. That's a massive department. Every state is different. They have a lot of lobbyists. They have to lobby at the federal level. They have to lobby at each state government level. So yeah, it's huge. California, Texas, Florida, New York. You have a lot of work you got to do. So that's very expensive. At USA is probably hundreds, if not thousands of people. Some of them are lawyers, and other people are really knowledgeable. So my job was on the investment side, both on the life insurance side and the property and casualty side. I found the life insurance a lot more fun to do because it was much more integrated with the product. But the P&C side was a lot of fun as well. The legal structure of insurance companies is really unique. You won't see this in banking and other industries. There's 3 types. There's stock companies, mutual companies, and reciprocals. So stock companies are publicly traded companies that you can buy stock in, like Allstate, Chubb, MetLife. Most of them have a holding company. We might see this later in the semester. If I show y'all Allstate, you'll see Allstate has a holding company that's not an insurance company, and it will own the insurance companies. And the reason for that is when you're borrowing money in the markets, in the public markets, you don't want an insurance company borrowing money because you don't want a regulated entity to be borrowing money. So Allstate creates a non-insurance company that owns all the insurance, and that's the entity that buys. You probably have heard, that borrows. You probably have heard the term holding company. A mutual insurance company is not publicly owned. It's owned by its policyholders. It's kind of like a credit union. If you know what a credit union is, credit unions are not publicly traded. They're owned by their customers. They may have stock subsidiaries that they own. So State Farm is a mutual. State Farm's life insurance company is a stock company owned by State Farm. So you can't invest in State Farm's life insurance company, even though it's a stock company. It's wholly owned by State Farm. So these are non-public companies owned by their policyholders. So State Farm, Northwestern Mutual, obviously, is a mutual. We'll talk about a couple of others. Reciprocals. What's a reciprocal you can think of that you could probably walk to? USAA is a reciprocal. There's only 2 reciprocals I know of, Farmers and USAA. There's probably a couple of others. Farmers is a unique one because it's bizarrely owned by Zurich. I don't understand that structure. USAA is a fairly unique reciprocal. It is owned by its policyholders, but in a very unique legal way that gives it a unique status to its CEO, but most importantly, it gives it enormous tax advantages. I'll just tell you, it was shocking me. We did a major study of USA on the investment side, and one of our issues was taxes. How should we take USA's tax treatment, and how should that influence how we invest? And when I got to the owning stocks, USA has a stock portfolio. I had to look at what was the before tax return on stocks and after tax return. Usually when you buy stocks, your before tax return is higher than your after tax return. At USAA, their stocks, they make more money on stocks after tax than they do before tax. Really bizarre. Y'all want to know how they do that? It's really bizarre. All right, well, I'll tell you. So they're reciprocal. So if you own a stock and it pays you a $100,000 dividend, okay, that's $100,000. Well, USAA, because of the reciprocal, they can allocate that to their policyholders, and that's tax deductible. So they have $100,000 in taxable income, but they offset it by allocating that to their policyholders, so there's 0 tax. That's for the reciprocal. But they file a combined consolidated tax return, which includes all their companies. Well, on the consolidated side, they get what's called a dividends received deduction, which means they get to deduct $100,000, 85% of the 100. So they actually get a tax deduction for the dividends at the consolidated level, but they don't pay any tax for it at the reciprocal level. When I did the math on that and I presented to the exec council, like, yeah, our after tax return on stocks is higher than before. And I was thinking about ways we could really take advantage of that. And they're like, no, we can't do that. If the IRS thinks we're taking advantage of this, they're going to shut the whole thing down. But I said, yeah, but we should at least keep doing what we're doing and get as much advantage out of it. So reciprocals have a huge advantage because when they allocate, they don't have to pay it. When they allocate income to their policyholders, that's tax deductible immediately. So you just allocate income all you want to, and you can create an incredible advantage. The issue USA had was they allocated so much to their policyholders. People were worried about all these policyholders that were 60, 70, 80 years old that had like $70,000 sitting in their account, and USA is like, they're going to all quit at once. We're going to have to pay out billions of dollars. So it made the rating agencies a little nervous. So they pulled back on that. I'm over there like, let's go. We can take advantage of this. And they're like, yeah, this is getting a little dangerous. But it is a unique company. So stock, mutuals, and reciprocals. So there's a company out there called Mutual of New York, but it now is known as Money. It may not exist anymore. It might have gotten bought out, but what do you think Mutual of New York is? It is stock, mutual, or reciprocal? You would have thought mutual, but they changed their name to Money. Why? Because they demutualized. They went from a mutual insurance company to a stock company. So mutual goes public. Probably the most famous mutual go public is a company. It's The Rock. Have y'all heard of The Rock? Prudential Financial. Prudential Financial used to be a mutual insurance company, and they demutualized. They became a stock company. So how in the world does that work? So you're Prudential and you're owned by your policyholders, and you want to be a publicly traded stock. Well, you go to the regulators and you figure out a way to divvy up the value of the firm to all your policyholders. And essentially, you figure out that Bob gets 20 shares, Mary gets 10 shares, Sam gets 33. How do they do that? They have to work that out with the regulators. And then they send out shares of stock to all of their policyholders. So we actually, my parents actually had life insurance with Mutual of New York. And so when they demutualized, My dad got all these shares of stock. He thought his insurance had gotten canceled, but it hadn't. He just had shares of stock. And he sent it out to each one of us. For some reason, he should have just kept it because he was paying the insurance, but he sent to all of us. So my brothers were asking, should we keep it or should we sell it? It's like, it's pretty easy. Were you going to buy the stock yesterday? No, we had no intention to buy it. Well, then you should sell it today. Just because someone hands you stock, you shouldn't, just sell it. You weren't thinking about it. You were going to do anything, just sell it, get the money for it. But that's how you demutualize. I can't imagine Prudential, as large as they are, what that process, that must have taken them forever with the regulators. It's a firm with $736 billion in assets. It's a big firm. Its market cap is $36 billion. So obviously you don't do that really, really fast. It's going to take quite a bit of lawyer work, legal work to get that approved. Could USAA demutualize? It would be tough, and I don't think they would ever do it. One thing though, I will say USAA does have a holding company. USAA borrows a lot of money. It's not at the top because the biggest company at USAA has to be the reciprocal. But the reciprocal owns a holding company, and then they use that. It's called the capital corporation. The capital corporation is the one that borrows the money. So they kind of have it backwards because they can't have a holding company over the top. State Farm can't have a holding company at the top, but they probably do have a holding company. All right, so there's the industry. I'm trying my hardest to get more of the industry to come interview. It was interesting, the two commercial firms that came in last semester, they were talking about an intern program and that they are hiring here in town. So, we're trying to get USA hires a lot of our students, but we need to get more people coming to campus. All right, homeowners insurance. We're going to shift gears here pretty quick. Any questions on anything we've come up so far? All right, so what we're going to do with homeowners insurance, we're going to talk about the policy, talk about key risk and issues with it, and then we'll do a special issue related to this. For homeowners, our biggest focus is going to be on catastrophe risk. How do you handle catastrophe risk for homeowners insurance, earthquakes, hurricanes? And then we'll have math. We're going to have two math problems on this. You can see from the exam guide, we're going to do a probable maximum loss, and we're going to do risk securitization. This is the easy problem. It has a short essay part to it that's pretty simple. And then the risk securitization, which is one of my favorite problems. It looks very, very similar to those like my life insurance class when we were doing equity-linked annuities. It's very similar type of math. Do y'all know who the first insurance company was to do risk securitization? Any guesses? You could walk to them. So yeah, USA was the first firm to do risk securitization. They were very proud of it, and they should have been. Their P&C actuary, I can't remember that guy's name. But he was very proud of USA doing that. It was quite industry changing because it's really popular today. So we'll talk about it. I've met some people that are experts in this area. They're actually selling these securities. I might have them speak to the class. I talked to them last semester. It was really fascinating. So we'll talk more about this. I might have learned everything I need talking to them for a few sessions. So I might just handle it on my own, but we'll see. It might be interesting. So those are the two math problems. One's really straightforward, pretty simple. This one, everybody should get 100 on because the math, I think, is pretty straightforward. It's math that you do all the time in finance, but there are students that miss that question for some reason. So that could be our exam. We'll see if I add the other essay question. So homeowners, I can't really get into detail in it because every state is different. Usually when this class is taught at other universities, they actually go into detail state by state by state. It is excruciatingly boring. They talk about the contract. They talk about the exceptions to the contract. They talk about the exceptions to the exceptions to the contract. Every state is different. There's no human way possible you're going to remember more than 0.1% of that. So it's really a kind of a waste. If you get in this industry, you're not going to learn it anyway because you're going to do one state. You're going to learn one state really, really well, and you're not going to worry about the other 49 states. So it's kind of a waste to do that. So we're going to do a very high level policy. We're going to take the ISO policy and talk about the key components there. I'll show you what the state of Texas says about homeowners insurance. You can get that off of their website. So homeowners is a packaged policy. Most of your insurance is packaged. So it includes both property and liability in one product. Your auto insurance is both property and liability and a few other things. Even though the insurance company actuaries are actually view those as two separate risks, they'll put it in one product for you. We're going to look at the standard policy. So how can you be eligible for this? You own or rent a dwelling that's primarily for residential purposes. All right. You're going to see on the homeowner side, they don't want a lot of business exposure. So if you're doing a daycare center out of your house, you got your lawyer or your accounting or your actuarial sign outside. Be careful. Anytime you start doing significant business in your home, you can change the nature of this. A lot of people say, well, I don't want to tell the insurance company that because then I'm going to be charged more. Well, the worst thing you do is not tell them. Then you have a claim and they're not going to pay the claim because of the business exposure. You can have incidental occupancy sometimes, but it needs to be principally a residence. You have to be careful again about business. So if you have a place where you only, I don't know about timeshares. I don't know why anybody buys timeshares anymore because the press has been so bad. I've never looked at them. But what is your exposure if you're only there a few days out of the year, something along those lines. So be careful of that. If you're not sure, call your insurance company and say, I got this house. It's a vacation house, but I'm only really there once or twice a year. I rent it out all the time. Those kind of things. Make sure they know exactly what you're doing. There is a limit. You can't have a 50-unit apartment complex and you live in one of them and own the complex. That's going to be very different, but you can do other. You can own a condo that's 4 family homes or something like that. There are some size and minimum value requirements. I know this tiny home thing is a big thing. Y'all have seen that. I don't know how small a house can get when you're still insured. Some of those houses look really, really nice. And it is possible that someone who is not the homeowner can actually have insurable interest. Your mortgage bank can certainly have interest in the house. A life tenant, that's someone who is allowed to live on the property even though they don't own it. And the history of USAA is very interesting. There was a woman who lived on that property, and what USAA said, we want the property, we'll build around your house, we'll buy your house, but you get to live there the rest of your life. And so I don't know when she passed away, it'd be an interesting history. When she passed away, they told the CEO, now you can live there. And he was like, no, I don't want to live on USA campus. So they turned it into a really, really nice conference center. But she had insurable interest because if the house burned down, you can say, hey, it's not your house anyway. So yeah, but now where I'm going to live. So she could actually get some insurable interest there. So the policy forms, the liability side is the same for all of them. It's the property side that makes them unique. Whether you own the property or it's a condo or if you're a renter, the property side is what makes them unique. And the policies can be all risk, which covers everything except for what's excluded, or they can be named peril. Most of you are doing all risk, which means if it's all risk, you need to go in and read the exceptions. We insure everything but these things. If it's named perils, you need to read the perils and make sure something like flood is not covered. That's going to be true on all risk if you cover everything except for flood, but what is not covered. So, all right, we'll start here next time, talk about these policy forms. It's going to be really, really important when we talk about mold.